Goldman Sachs just walked away from the American dream. While everyone else was distracted by the latest celebrity news or arguing about political headlines, the smartest guys on Wall Street quietly hit the sell button on $847 billion of U.S. government bonds. This is the financial equivalent of the captain of the Titanic being the first one to hop into a lifeboat while the band is still playing. You probably think U.S. bonds are the safest place for your money. That is what the textbooks say. But when the bank that basically runs the world's financial plumbing decides to dump nearly $1 trillion worth of them, you have to ask yourself, what do they know that you don't? In this video, I am going to show you the exact numbers behind this move, the hidden signals in the latest inflation reports, and why the safe path you've been told to follow is actually a trap. By the end, you will see the 3 signs of the collapse they are preparing for and how you can move money before the exit doors lock. Most people have a very specific expectation when they hear about big banks and the economy. You expect things to be stable, or at least predictable. You think the government has everything under control. But the reality is that the foundation of the global market is cracking. We are going to look at the hard data from the Bureau of Labor Statistics and the Federal Reserve, and I promise you, it is not what you are hearing on the evening news. If you have a pension, a savings account, or any money in the stock market, you cannot afford to ignore this $847 billion warning. Let's start with the first part of the puzzle, the inflation mirage. For months, we've been told that inflation is coming down. But if you look at the Consumer Price Index data released for December 2025, the All Items Index actually rose 0.3% in just 1 month. Over the last year, it is up 2.7%. Now, that might not sound like a world-ending number, but you have to look at what is driving it. Food prices are up 3.1%, and food away from home is up a massive 4.1%. But the real kicker is energy. Energy services have jumped 7.7%, with natural gas prices spiking by a staggering 10.8%. When the cost of basic survival, eating and keeping the lights on, is rising that fast, people stop spending on other things. This creates a belonging gap in the economy. You feel like you are working harder, but standing still. Goldman Sachs sees these numbers and they realize that the old way of measuring growth is broken. They are looking at the gross domestic product, which is supposed to be the comprehensive measure of the U.S. economy. And they are seeing a disconnect between the official growth and the actual cost of living. So why bonds? To understand this, we have to look at interest rates. U.S. government securities like the 10-year and 30-year Treasury bonds are what the entire world uses to price risk. As of late January 2026, the 10-year Treasury yield was sitting at about 4.26%, while the 30-year was at 4.84%. Now remember, when yields go up, the price of the bond goes down. If Goldman Sachs is selling $847 billion in bonds, they are essentially saying they expect interest rates to keep climbing. They are getting out now because they don't want to be holding the bag when those bond prices crater. This is what I call the bond cliff. If you hold a bond that pays 4%, but the new bonds coming out pay 6%, nobody wants your old bond. Its value drops. By dumping their holdings now, Goldman is moving into a cash-heavy position, just like we've seen with other major players. They are waiting for the moment reality beats expectations. But there is a second, more sinister reason for this sell-off. It involves something called financial stress. The Office of Financial Research tracks a financial stress index, which is a daily snapshot of how much pressure is in the global markets. When stress levels are high, liquidity, the ability to move money easily, starts to dry up. Goldman Sachs mentioned in their 2025 reports that their strategy is anchored in interconnected global banking and markets. They want to be the ones providing the capital when everyone else is panicking. Imagine there is a massive fire in a crowded theater. Everyone is running for the same small exit. Most people will get crushed. But the guy who already stood up and walked out 10 minutes ago, he is standing outside, watching it happen, ready to buy the theater for pennies once the fire is out. That is Goldman Sachs. They are seeing opportunities others don't. By selling $847 billion in bonds, they are clearing their balance sheet to make sure they have the firepower to buy up distressed assets when the collapse hits. Think about the somebody wanted but so then framework for a moment. Goldman Sachs wanted to maintain their position as the world's most exceptional financial institution, but they saw the rising inflation in energy and food and the instability in the treasury market. So they decided to liquidate a massive portion of their U.S. debt holdings to stay liquid. Then they positioned themselves to profit from the very volatility that will ruin average investors. Now you might be wondering, is it just Goldman? The answer is a loud no. If you look at the 2024 and 2025 reports from J.P. Morgan Chase, you see a similar focus on financial health and wealth creation while preparing for community development after shifts in the market. The big banks are all reading the same map. They are moving away from the paper wealth of government debt and into the real wealth of market control. Let's talk about the expectation versus reality gap in your own life. You expect that if you put your money in a safe bond fund, it will be there when you retire. The reality is that if inflation stays at 2.7% or higher, and energy costs keep rising at nearly 8%, your safe return is actually a loss in buying power. You are losing money slowly every single day. Goldman Sachs doesn't do slowly. They move fast. The third sign of the collapse is the debt trap. The U.S. government has to pay interest on all those bonds Goldman just sold. When the bank prime loan rate is at 6.75% and the discount window is at 3.75%, the cost of borrowing for the entire country is going through the roof. We are reaching a point where the government might have to print even more money just to pay the interest on the money they already borrowed. And what happens when you print more money? Inflation goes up even more. It is a death spiral. Goldman Sachs is basically shorting the U.S. government's ability to manage its own debt. They are saying, we don't believe you can keep this up. This is a bold statement from a bank that is usually seen as a partner to the Treasury. In their own words, they focus on excellence and integrity. But their actions show they are prioritizing survival over loyalty. I want to share a story about a bridge. In a small town, there was a bridge that everyone used. It looked solid. It was made of stone. But a team of engineers noticed that the water underneath was moving differently, and the ground was shifting. They didn't tell everyone to stop using the bridge because that would cause a panic. Instead, they just quietly stopped driving their own trucks across it. They started using the long way around. Goldman Sachs is the team of engineers. The U.S. bond market is the bridge, and you are the guy still driving his car across it because you think stone lasts forever. So what should you do? If you can't sell $847 billion in bonds, how do you protect your few thousand or few £100,000? First, you have to stop thinking like a retail investor and start thinking like a global bank. You need to look for things that have intrinsic value. Goldman's strategy is to grow and strengthen existing businesses and operate more efficiently. For you, that means investing in yourself, your skills, your ability to produce value, and looking for assets that aren't tied to the crumbling debt of a single nation. You need to watch the short-term funding monitor and the hedge fund monitor from the OFR. These tools indicate vulnerabilities within the financial system. When you see leverage in hedge funds start to spike, or the financial stress index move into positive territory, meaning stress is above average, that is your signal that the Goldman move is about to trigger a wider reaction. There is a concept in viral script writing called the pattern interrupt. Your brain is used to the pattern of the stock market always goes up, and the dollar is the safest currency. I am interrupting that pattern. The data shows that shelter costs are up 3.2% and hospital services have jumped a shocking 6.6%. The cost of living is not just rising, it is accelerating in the areas that matter most. If the things you need to stay alive, health, home, and heat, are all getting more expensive at twice the rate of the official inflation, then the system is already failing you. Goldman Sachs is moving into a differentiated client franchise. They are moving towards asset and wealth management, where they can control the actual things people own, rather than just the debt people owe. This is the great pivot. We are moving from a debt economy to an asset economy. In a debt economy, you win by borrowing. In an asset economy, you win by owning. I know this is a lot of information. It can feel overwhelming to hear that the bedrock of the global financial system is shifting. But remember what we talked about regarding belonging. You aren't just an observer. You are a participant. Every choice you make with your bank account is a vote for your future. If you keep your money in the same place, Goldman is fleeing from you are voting to go down with the ship. Let's look at the why, what, and how of the situation. Why did they sell? Because inflation is stickier than promised. Energy costs are exploding, and interest rates are making debt too expensive to hold. What did they sell? $847 billion in U.S. Treasuries. How does this affect you? It signals a massive drop in bond prices, a likely spike in inflation, and a shift in how wealth is protected globally. One thing the mainstream media won't tell you is that the Bureau of Labor Statistics is constantly updating seasonal factors and changing how they measure these things. They even have special notices about how government shutdowns affect the data. This means the official numbers you see are often the best-case version of the truth. If the best-case version shows energy up 7.7%, the reality on the ground is probably even worse. Goldman Sachs has a track record of success because they see opportunities others don't and create value others can't. Right now, they see the opportunity to get out of a failing trade before the rest of the world catches on. They are following the high retention rule of finance. Don't let your money get bored in an asset that is losing value. Keep it moving to where the growth is. I want to point you to the relink hack for your own life. Don't just watch this video and go back to your day. You need to connect this information to your next move. If you realize that bonds are no longer the safe haven, you need to find the next room in the economy. Is it commodities? Is it international markets? Is it physical assets? Goldman is diversifying their products and services to find the answer. There is a climax coming to this story. It will happen when the Federal Reserve is forced to choose between saving the bond market and saving the dollar. If they keep interest rates high to fight inflation, the bond market collapses. If they lower rates to save the bonds, the dollar collapses through hyperinflation. Goldman Sachs has already made their choice. They have sold the bonds. That tells you which side they think will lose. Think about the hero's journey for a second. You are the hero. The old world of stable bonds and easy 4% returns is the ordinary world you are leaving behind. The $847 billion move by Goldman is the call to adventure. It is the signal that the old world is gone. You are now entering the special world where the rules are different and the stakes are higher. You need a mentor, someone or something that can show you the new map. The data from the OFR and the BLS is that map. I've been tracking these moves for a long time. I've seen the way banks like JP Chase celebrate their global headquarters, while the average person struggles with motor vehicle maintenance costs that are up 5.4%. There is a widening gap between the people who own the system and the people who are owned by it. Goldman Sachs' move is the ultimate proof of that gap. Everything I've just told you about Goldman Sachs and the bond market is completely useless if you don't know how to protect your own cash from the inflation that is coming next. If natural gas is up 10.8% and hospital services are up 6.6%, your savings are being eaten alive. You need to know which assets are inflation-proof and which ones are collapse-proof. This video was a masterclass in seeing the hidden gears of the economy. We looked at the CPI reports, the Treasury yields, and the strategic shifts of the world's most powerful bank. We used the value loop to explain why this matters. The context is the bond sale, the application is moving your own money, and the framing is the survival of your wealth. Don't be the person who stands at the edge of the party with a cup while everyone else is dancing toward the exit. The lights are flickering. The music is slowing down. Goldman Sachs has already called their car. It is time for you to look for the door. Let me know in the comments. Do you think the U.S. government can actually pay back its debt? Or is Goldman Sachs right to get out now? I read every single comment because I want to know how you are seeing the world shift. The $847 billion warning is the most important signal of 2026. Don't ignore it. Stay sharp, stay informed, and I will see you in the next video to help you navigate the end of the old economy.